If I had to start investing from absolute zero today, no money, no experience, no insider connections, just knowledge and discipline, here is exactly what I would do, step by step. And before we go any further, if you want financial freedom instead of financial stress, hit subscribe right now, because everything on this channel is built for people who want control over their money, not hype, not shortcuts, but systems that actually work. And by the end of this video, you'll have a clear mental blueprint you can follow for years, not days, not weeks, years. And the first thing I would understand is that investing is not about getting rich fast. It's about not getting poor slow, because most people don't lose money in one dramatic mistake. They lose it quietly through inflation, bad habits, emotional decisions, and inaction. So before buying a single stock or crypto or ETF, I would fix my foundation, meaning I would track every dollar coming in and out for at least 30 days. Not to restrict myself, but to understand myself. Because you can't grow what you don't measure, and I would build a basic emergency fund, even if it's just $1,000, because investing without a safety net forces you to sell at the worst possible time. And once that base is set, I would shift my mindset from how do I make money to how do I build a machine that makes money without me? Because income pays bills, but assets change lives. And with zero experience, I would avoid complexity like the plague. No day trading, no options, no leverage, no following gurus on social media screaming about the next big thing. Instead, I would start with boring, simple, repeatable strategies, because boring is predictable and predictable compounds. And the first actual investment I would make is in myself, not courses that promise Lambos, but learning how money actually works, understanding compound interest, market cycles, risk, reward, and time horizons. Because once you understand those concepts, every investment decision becomes clearer. And then I would open a low-cost brokerage account, something simple, reputable, and beginner-friendly, because access matters. And I would automate everything from day one. Automation removes emotion, and emotion is the enemy of consistency. And with my first investable dollars, I would start with broad market index funds. Not because they're exciting, but because they work. Funds that give me exposure to hundreds or thousands of companies at once, spreading risk automatically, letting me benefit from global economic growth without trying to guess winners. And I would invest small amounts consistently, weekly or monthly, even if it's only $20 or $50, because consistency beats intensity. And I would treat investing like brushing my teeth, not something I think about emotionally, just something I do. And while the market goes up and down, I would remind myself that volatility is the price of admission, not a signal to panic. Because every market crash in history has looked like the end of the world while it was happening, and an obvious buying opportunity in hindsight. And as my income grows, I would increase my contributions before increasing my lifestyle. Because lifestyle inflation is the silent killer of wealth. And once my core portfolio is solid, I would slowly expand, adding diversification across asset classes, maybe some bonds for stability, maybe international exposure, maybe later some real estate through REITs if direct property isn't an option yet, but always with intention, always knowing why I'm buying something, not because someone told me to. And I would keep a long-term perspective at all times. Because the real magic of investing doesn't happen in the first year or even the fifth year. It happens when time and compounding start working together. When your money starts earning more than you do. And at that stage, I would focus heavily on protecting my downside. Understanding taxes, using tax-advantaged accounts wherever possible, because what you keep matters more than what you make. And I would stay paranoid about fees, because a 1% fee doesn't sound like much until you realize it can steal hundreds of thousands of dollars over a lifetime. And I would ignore noise, headlines, predictions, and fear-based media, because the market doesn't reward the most informed, it rewards the most disciplined. And I would remind myself constantly that investing is not a competition. There is no finish line, only progress. and I would avoid comparing my chapter 1 to someone else's chapter 20. And once my investments start growing, I would reinvest everything, dividends, gains, returns, because compounding accelerates when you stop interrupting it. And only much later, after years of consistency, would I explore higher risk opportunities. Maybe individual stocks, maybe private investments, but only with money I can afford to lose, never risking the foundation for the thrill of upside. And throughout the entire journey, I would keep learning, adjusting, refining, because the goal is not perfection, it's resilience. And if you've made it this far and this mindset already feels different from what you've been told before, that's a sign you're thinking long term. So like the video and subscribe, because this channel is built for people playing the long game. And as I approach financial independence, I would redefine success not as net worth, but as freedom. Freedom of time, freedom of choice, freedom from stress. Because money is just a tool, and the real return on investing is the life it allows you to live. And if I had to sum it all up, starting from zero isn't a disadvantage, it's an advantage, because you have no bad habits to unlearn, no ego to protect, no losses anchoring your decisions, only a blank slate and time is the most powerful asset you'll ever own. And if you take anything from this video, let it be this: start now, start small, stay consistent, ignore the noise, trust the process. And if you want more breakdowns like this, more real-world investing strategies, and a roadmap you can actually follow, subscribe right now, because your future self is already depending on the decisions you make today. And once that foundation is set and the habit is locked in, I would zoom out and realize something most people never do: that investing is not just about markets, it's about behavior. Because the math of investing is simple, but the psychology is brutal. And that's where most people fail. Not because they picked the wrong asset, but because they abandoned the plan at the wrong moment. So I would build systems that protect me from myself, rules that don't care how I feel on any given day, rules that stay the same whether the market is euphoric or terrifying, because feelings are temporary but decisions are permanent. And one of the most powerful rules I would adopt early is this: never make investment decisions during moments of emotional intensity. No buying because of excitement, no selling because of fear. Instead, every decision would be delayed, reviewed, and measured against my long-term goals, because time in the market beats timing the market. And I would stop thinking in terms of months and start thinking in decades, because wealth is built quietly while everyone else is distracted. And I would internalize that investing rewards patience disproportionately, meaning the longer you stay consistent, the faster progress appears to happen. And this is where most beginners get discouraged, because the early years feel slow, painfully slow, like nothing is happening, but under the surface compounding is working. And the people who quit right before momentum kicks in never see the payoff. So I would remind myself constantly that boredom is a sign I'm doing it right. And as my confidence grows, I would resist the temptation to complicate things, because complexity feels productive, but often reduces results. And instead, I would double down on simplicity, increasing contributions, staying diversified, and letting time do the heavy lifting. And I would treat market downturns not as threats, but as opportunities, because lower prices mean higher future returns for long-term investors. And while everyone else panics, I would zoom out and see discounts, not disasters. And I would train myself to detach my identity from my portfolio balance, because numbers fluctuate, but my strategy doesn't. And this emotional detachment is what allows investors to survive long enough to win. And then I would start thinking about income streams versus asset growth, understanding that some investments are designed to grow while others are designed to pay. And I would balance those based on my stage of life, prioritizing growth early and stability later. Because investing is not static, it evolves as you do, and I would begin to see money as a workforce. Every dollar an employee, every investment a manager, and my job is not to work harder, but to allocate smarter. And this shift alone changes how you view spending, because every unnecessary expense is not just money gone, it's future growth sacrificed. And that realization creates discipline without deprivation, because you're no longer saying no to yourself, you're saying yes to your future. And as years pass, I would track progress not daily or weekly, but annually, because zooming in creates anxiety while zooming out creates clarity. And I would celebrate consistency more than results, because results fluctuate, but consistency compounds. And once investing becomes automatic, I would focus more heavily on increasing my earning power, because the fastest way to accelerate investing is not higher returns, it's higher contributions. And that means skills, leverage, and scalable income, because you can't out-invest a low income forever. And I would funnel raises, bonuses, and side income directly into investments before lifestyle creep has a chance to absorb them. And this single habit alone separates people who build wealth from people who stay stuck despite earning more. And throughout all of this, I would ignore shortcuts, because shortcuts usually skip the most important part: durability. And durability is what allows wealth to survive market crashes, recessions, job losses, and life changes. And I would constantly stress test my plan mentally, asking myself if I could stick with it during a 30% drop, a 50% drop, or a multi-year downturn. Because if the answer is no, the strategy is too aggressive, and sustainability always beats optimization. And eventually, after years of steady progress, I would start seeing something shift. The returns start rivaling my contributions. The portfolio begins pulling its own weight. And this is where patience pays off, because this phase feels like magic to people who haven't experienced it, but it's just math meeting time. And instead of changing strategies, I would protect what's working, because success creates new risks, overconfidence, complacency, and unnecessary risk-taking. And I would remind myself that the goal is not to maximize returns, but to maximize the probability of reaching my goals. And that distinction matters. Because chasing the highest return often comes with the highest risk, and risk doesn't announce itself until it's too late. And as financial independence moves from concept to reality, I would start designing my life intentionally, because money without purpose leads to confusion, and purpose gives money direction. And I would ask myself what freedom actually looks like to me, not what social media sells, but what I value: time, flexibility, peace, creativity. And I would align my investments with that vision, because the ultimate return on investing is not a number, it's control. Control over your time, your energy, and your choices. That means you're serious about understanding money at a deeper level, not just surface level tips. So make sure you're subscribed, because this channel is about long-term thinking in a short-term world. And as the years continue, I would shift gradually from accumulation to preservation, reducing risk intentionally, building buffers, and ensuring that my wealth can withstand shocks without forcing lifestyle changes. Because true wealth is resilience, not fragility. And I would teach these principles to anyone willing to listen, because knowledge compounds too, and helping others reinforces your own discipline. And if I ever felt tempted to gamble, speculate, or chase trends, I would remind myself how far consistency has already brought me, because nothing kills momentum faster than abandoning a proven system for excitement. And I would stay humble, because markets have a way of punishing arrogance, and I would stay curious, because stagnation is just as dangerous as recklessness. And over decades, I would watch a simple plan outperform complex ones, not because it's smarter, but because it's survivable. And survivability is the secret ingredient nobody talks about. And if I had to give one final message to anyone starting from zero, it's this: your greatest advantage is time, your greatest enemy is impatience, and your greatest asset is discipline. And if you master those three, the details matter far less than you think. And this journey doesn't require brilliance, luck, or perfect timing. It requires showing up consistently when it feels boring, when it feels slow, and when it feels uncertain, because that's when compounding is doing its quiet work. And if this video helped shift how you think about investing, don't keep it to yourself. Like the video, share it with someone who needs it, and subscribe because the next videos will go even deeper into building real wealth step by step. Not hype, not noise, just systems that work over time. Because your future isn't built in moments of excitement, it's built in moments of discipline, repeated long enough to matter.